Anyone who has studied economic cycles for decades knows we're living through a very peculiar moment in American history. The signals are converging in ways we rarely see. The national debt has surpassed $33 trillion. Interest rates have risen faster than we've witnessed in generations. The housing market shows evident stress, and millions of Americans feel daily inflationary pressure eroding their purchasing power. If you depend on a salary, retirement in American stocks, or appreciation of domestic assets, this cycle isn't abstract. It hits directly at your life, your home, your future. But here's what most people don't realize. This transcends a simple, normal economic fluctuation. We're at the epicenter of much larger historical forces, forces that repeat in identifiable patterns across centuries. The question isn't whether a recession will happen, the question is when, and more crucial, whether you'll be prepared or caught off guard. This isn't a prediction based on hopes or fears. It's a logical consequence of how economic systems function when observed through history's lens. After analyzing decades of data and managing trillions through multiple cycles, one truth emerges clearly. Those who understand historical patterns possess a decisive advantage over those who live merely reacting to daily events. At this moment, these patterns are aligning in ways that should capture any thinking person's attention, because when you understand cycles, you can position yourself adequately before they turn. But if you ignore them, you could spend years recovering what you lost in a matter of months. History is an excellent teacher, and its lessons about recessions are crystal clear. They aren't random accidents, but natural and necessary adjustments that occur when imbalances accumulate beyond the system's capacity to sustain them. Observe the pattern. In 1929, before the Great Crash, the dominant belief was perpetual prosperity. The stock market rose consistently, people bought with borrowed money, convinced prices could only ascend. Sound familiar? 2007 repeated the same melody with a different variation. This time, houses could never lose value. Families acquired properties they couldn't afford with loans they couldn't honor. And in 2000, the conviction was that the digital economy had made traditional rules obsolete. The pattern remains consistent through the ages: excess, complacency, and then the inevitable adjustment. But the current moment carries additional significance. We're not facing just a short-term economic cycle. We're simultaneously navigating much deeper long-term structural changes. The long-term debt cycle, which historically lasts 50 to 75 years, finds itself in an advanced phase. The United States has accumulated debt levels that preceded major economic restructurings in the past. Parallel to this, we're witnessing changes in global power balances. China has emerged as a real economic force. The post-World War II established order faces systematic questioning. Additionally, we're witnessing the largest wealth transfer in history as the baby boomer generation transitions into retirement. All these cycles are converging simultaneously, a rare and significant confluence. This doesn't signal the end of the world, but indicates our entry into a phase of changes and adjustments more substantial than most are prepared to face. Understanding this allows proper positioning. Ignoring it places you at the mercy of much superior forces. To navigate effectively, first, you must understand how systems really operate. Nature is fundamentally cyclical. The economy moves in cycles because human behavior is cyclical. During prosperous periods, growing optimism leads to assuming greater risks. This generates short-term growth, but simultaneously creates systemic imbalances. Eventually, these imbalances exceed the capacity for sustenance. Then the adjustment occurs. Pessimism replaces optimism, risk reduction replaces expansion, and economic contraction replaces growth. Debt functions as an accelerator for these cycles. When credit flows easily, spending exceeds production. This stimulates immediate economic activity, but creates inevitable future obligations. Eventually, spending must be reduced to honor past commitments. When this happens on a broad scale, recessions emerge. It's elementary mathematics. Spending 110% of income today requires spending less than 100% tomorrow to rebalance. Incentives determine behavior with predictable precision. Understanding incentives means understanding future actions. Low interest rates incentivize borrowing and investing. High rates incentivize saving and conservatism. Rising prices incentivize buying. Falling prices incentivize selling. Politicians face their own incentives. Re-election favors short-term popular policies, even when creating long-term problems. Diversification represents the only free lunch in investing. No asset is perfect. All carry specific risks. The only methodology to reduce total risk without sacrificing return is true diversification. But real diversification transcends buying various stocks. It means distributing risks across different types of assets, diverse currencies, distinct geographies, and varied economic scenarios. The true risk lies in inadequate preparation for multiple scenarios. Most people plan for continuity, that current conditions will persist indefinitely, but reality rarely mirrors the present. Preparation for a single scenario creates vulnerability to all others. Adequate preparation means positioning to prosper or minimally survive in diverse economic environments. Deflation, inflation, growth, recession. Each demands specific strategies. Consider two families in 2006. The Smith family owned a $400,000 house, owing $350,000 in financing. Their wealth concentrated in real estate value. When questioned about possible price decline, they responded, "Real estate never loses value in our area." They planned retirement based on continuous property appreciation. The Johnson family lived in a similar house, but owed only $200,000. They maintained diversified investments, selected stocks, government bonds, precious metals exposure, and substantial emergency reserves. When asked about potential real estate correction, they responded, "It's possible. We're prepared for varied scenarios." 2008 arrived. The Smith house value plummeted to $280,000. They owed more than the property's value. A medical emergency forced the sale, requiring additional capital to liquidate the debt. They lost their savings and entered retirement in severe difficulties. The Johnson house also fell to $280,000. However, owing only $200,000, they maintained positive equity. Being diversified, when real estate fell, other positions appreciated, government bonds rose, precious metals appreciated. Crucially, they possessed liquidity to exploit opportunities emerging during the crisis. They acquired shares of solid companies at depressed prices. They bought additional property from a family in distress. When the economy recovered, they not only maintained their living standard, but significantly improved their financial position. The difference wasn't luck, it was preparation based on understanding cyclical functioning. In 1970, many considered gold ownership unnecessary paranoia. The United States seemed stable, the dollar strong, inflation controlled, but some perceived underlying fundamental changes. Government spending on Vietnam and social programs created growing deficits. The Bretton Woods system faced unsustainable pressures. Those who diversified into real assets like precious metals protected themselves from the subsequent inflationary decade. Between 1970 and 1980, gold ascended from $35 to over $800 per ounce. It wasn't speculative betting, but protection against a specific scenario that materialized. Today we face a similar, yet distinct situation. Deficits are larger, debt is higher, but this time interest rates started near zero, limiting traditional monetary policy tools. This doesn't mean betting exclusively on precious metals. It means preparing for scenarios where traditional assets may not behave as expected. How does this apply to your reality? First, brutal honesty about your current situation is essential. Most Americans are poorly prepared for significant recession. Recent 2024 to 2025 data indicates approximately 40% cannot handle a $400 emergency without resorting to loans. More than 60% lack savings for 6 months of expenses. If that's your situation, building basic financial resilience must be absolute priority. But even in apparently comfortable financial position, you're probably more vulnerable than you imagine. Most people concentrate wealth in few assets: primary residence, retirement invested predominantly in American stocks, and dollar savings. This concentration works during stable growth, but becomes devastating during cyclical changes. If you're an upper middle class professional, probably income, property, investments, and retirement connect to the same economic system. When this system faces difficulties, all your wealth becomes simultaneously vulnerable. It's having all eggs in the same basket, even while believing you're diversified. Technology sector workers who live in areas where real estate prices depend on tech jobs with savings in technology stocks aren't truly diversified. Public employees in communities dependent on tax revenues with retirements and funds investing predominantly in the American market are more concentrated than appears. True preparation means breaking these correlations, having income sources independent of the same economy, possessing assets that behave differently in varied economic environments, developing skills and resources that maintain value regardless of financial market fluctuations. This isn't paranoia, it's fundamental prudence. Before sophisticated investment strategies, you need basic stability. This means 6 to 12 months of expenses and liquid emergency reserves, not in investments, but in immediately accessible cash. Yes, this capital will lose purchasing power to inflation, but the purpose isn't growth, it's survival and flexibility. During crises, liquidity becomes extremely valuable, not just for basic needs, but to exploit opportunities that arise when others face difficulties. Examine every aspect of your financial life asking, what could go wrong here? Variable rate debts merit refinancing to fixed rates while possible. Dependence on single income source requires developing alternatives. High fixed expenses necessitate creating flexibility. The goal isn't living in fear, but reducing exposure to external shocks before the cycle turns. True diversification transcends buying different stocks. You need assets that benefit from distinct scenarios. Long-term government bonds protect against deflation and severe recession. When the economy panics, investors run to the safety of American bonds. Commodities and real assets protect against inflation. When monetary value declines, physical goods value tends to rise. Stocks of solid companies with durable competitive advantages historically recover and grow long-term, even when traversing difficult periods. Real estate can provide income and partial inflation protection, especially when acquired with long-term fixed-rate financing. Some investors consider international assets, foreign currencies, or cryptocurrencies as extreme diversification components. The point isn't possessing all these assets, but having assets that react differently in varied scenarios. The most valuable asset is your income generating capacity. Skills valuable regardless of economic environment, professional and personal relationships offering support during difficulties, knowledge and experience providing advantages regardless of market fluctuations. During the Great Depression, those who suffered most depended completely on others for subsistence. Those who prospered best possess practical skills, solid relationships, and capacity to adapt to changed circumstances. Don't commit all wealth to illiquid investments. Avoid fixed financial commitments you can't honor if income diminishes. Keep options open. Flexibility is especially valuable during rapid changes. Being completely invested when opportunities emerge prevents exploiting them. Having liquidity and flexibility when others face difficulties allows positioning for the next growth cycle. The time to prepare is always before signals become obvious to everyone. Observing the history of great fortunes reveals something illuminating. They're rarely built during stable and predictable growth. They're constructed during change and turbulence by people prepared when others weren't. The Rothschilds built their financial empire during the Napoleonic Wars. Rockefeller consolidated his position during 19th century panics. Buffett made exceptional acquisitions during bear markets. I don't suggest anxiously awaiting crises. I suggest preparing to prosper regardless of what comes. Ironically, if enough people were adequately prepared, recessions would be less severe. It's the unprepared, forced to sell assets at unfavorable moments and drastically cut spending, who amplify recessions beyond necessity. Your preparation protects you and contributes to systemic stability. But deeper truth remains. Regardless of economic fluctuations, quality of life depends mainly on elements non-negotiable in financial markets. Your health, your relationships, your capacity to find meaning in daily life. Financial preparation should serve these higher priorities, not dominate them. The goal isn't getting rich, speculating on crises, but building sufficient security and freedom to focus on what truly matters. When recession becomes obvious, it will be too late for adequate positioning. Most important, cycles are temporary by definition. Recessions end. Bear markets transform into bull markets. Pessimism gives way to optimism. Understanding this allows maintaining perspective during difficult moments and exploiting opportunities they inevitably bring. History doesn't repeat exactly, but it rhymes with remarkable precision. For those who know how to listen, it's whispering important rhymes at this moment of the current cycle. The question isn't whether significant changes approach. The question is whether you'll be prepared to dance with them or be run over by them. In cycles, money rarely disappears. It simply changes hands. Now you know what you need to do.